Well, let's talk more about the broad outlook here. Stocks sliding today, setting up Wall Street for a weekly loss as investors weighing the impact of those hot inflation prints. Focus now turning to next week's Federal Reserve policy decision and the dot plot. Expectations that the Fed will hold off cutting rates till June. How can investors play a more patient Fed? For more, let's welcome in RaeAnn Mitrione, Callan Family Office Investment Management Partner, who's with us in studio. Thanks for being here.
Thanks for having me.
So this is the big question that a lot of people seem to be wondering. And I have seen some analysts and economists start to say, even if the Fed doesn't cut this year, stocks will be okay. What do you think?
I think that's entirely possible. I mean, the market has priced it in and is hoping that we start to trend in the right direction. But right now, the economy's strong, right? I mean, we have the employment market is incredibly strong. We got jobs that are, staying reasonably strong. Unemployment rate is near historical lows. Consumers are still spending. So we're in a really, strong spot. And as long as the economy stays strong, the market should stay strong. Now, if the Fed were to move too quickly and cut rates too soon and then have to reverse course if inflation started to trend back up, that would be a concern for the markets.
So you think the risk is weighted towards the Fed cutting too soon rather than waiting?
Yes. I think also the Fed they've been very clear that they were going to be patient. They're going to be data dependent. They're looking at what's happening. And, the last couple months, the inflation prints have been a little bit hotter than they probably want to see. But they had always essentially said it was probably going to be the back half of the year. And that's still what we expect, that we'll probably have 2 to 3 more, but it'll really be dependent on what we see over the next couple months, I think.
Do you, RaeAnn, also, you're seeing a number of strategies kind of expect, given the rally we've had. They're saying, listen, at this point, we're kind of overdue for a pullback. Pullback, generally defined as, drop somewhere between 5-10%. Are you looking for that? And if we saw that kind of pullback, would you see that as a buying opportunity?
I mean, we've certainly had a strong start to the year, right? I mean, we're up, 8%-ish on the S&P. It's been a strong start. I wouldn't be surprised to see a little bit of rockiness, especially with what we had this week with inflation, or, tech has been very extended. We've seen that broaden out some, but especially if we think rates are going to stay higher for longer, that could be a headwind for some of those shares. We're still pretty fully allocated right now as far as our equity allocations. Depending on how much of a pullback it is, we may view it as a buying opportunity. But if we just get, a 5% pullback, I think we're pretty comfortable with where we stand today.
Well, and then I guess the question is, are you participating in the pullback? In other words, the run-up that we've seen in tech, have you been sort of lightening some of your allocations there?
Absolutely. I mean, after last year was such a strong market, especially for the Magnificent Seven, so especially looking at those mega cap tech names, we have been taking some of those profits off the table. We still have a full weighting as far as tech goes, but pulling back some of that overweight that it had grown into, and looking at other areas that are just more attractively priced right now.
Like what, RaeAnn? What would those other areas be?
So, we're keeping a pretty balanced allocation between growth and value. So taking some of that and maybe allocating to healthcare and consumer staples, consumer discretionary areas that are just haven't really participated nearly as much to balance out the portfolios.
And then what about on the fixed income side as well, right? Because we've seen this run up in yields that's been happening recently, right, but we know a lot of investors still have money parked in things like money market funds. So how are you thinking about that area?
Yeah, now versus a few years ago, you can be diversified. You can own fixed income and actually get something out of it. You can even own cash and money market and at least get some sort of yield. So we are pretty neutral. Our equity targets and our fixed income targets, after being overweight equities and very underweight and defensive on fixed income for some time, we've added back into bonds and shifted that out to more of an intermediate duration from being more defensive on the short end. So we have our clients pretty well diversified, but we're still constructive on the equity markets.
And RaeAnn, we're going to be talking commodities later in the show, and some of them have just this incredible run. Gold, record highs here. Have you participated in that at all? Do you own the metal or the miners?
We do through some of the managers that we work with, but we don't typically have a direct allocation there. We invest some in the real assets on the private side, but that would be more on more real estate.
How closely though are you watching the commodities more as sort of a macro indicator, even a headwind, and especially as they play into the inflation story too?
Well, absolutely, and that was, you have kind of that last year, the don't fight the Fed on the commodities story, but this year it's switched a little where, we have energy prices coming back up, and I mean, energy stocks had been, they're still at a discount. They're still very attractive on, and we've seen energy prices and oil prices come back up this year. So it's certainly been what was factoring in this week on the inflation that we've seen. Energy was a big piece of that. And it's definitely something that we're looking closely at as far as what could come further down the pike this year.
And I admit I have energy on the brain because I'm actually about to go to CERAWeek, which is the big annual oil and gas conference that happens in Houston every year. And, there's been a lot going on in the energy industry, a lot of M&A. But, as an investor, why own the energy? Is it about capital return to shareholders? Is it about, I don't know how much growth you're looking for from the industry. How do you think about that group?
There are different ways to look at it. You can look at it as a diversifier, something to be a little bit different from the other asset classes that you own. You can look at it as an inflation hedge. And you can look at it, we invest some in the MLP markets. You just certainly can earn some income there, which is great. And that's been a great place over the last couple of years to be invested.
All right, RaeAnn, thanks for coming in.
Thanks for having me.
Appreciate it.